Welcome back to Alpha Recap, your quick, smart look at what moved markets today after the close. We're walking through Friday's tape and what mattered as we headed into the long weekend. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Friday's session, which closed on May 29th, was a wild mix. A real retail bloodbath on one hand, and on the other hand, some huge volume-driven spikes in speculative names. So, what really stands out here is the breadth of storylines in a single day.
Right. The headline moves were dramatic. Gap plunged about 24%, and American Eagle Outfitters fell about 13%. That was a big hit to mid-sized apparel names. Not a great day for retailers.
No, not at all. And then you had the opposite in the speculative corner. Virgin Galactic jumped about 37% on huge turnover, and a microcap called Devs exploded up 140% to 30 cents on about 572 million shares. Those are the kinds of numbers that make volatility spikes.
And of course, there was a mirror image. ZCMD tumbled about 69% to 17 cents on about 146 million shares. So heavy volume, big moves in both directions.
Exactly. And even big cap names weren't immune. Intel slid about 5% to $114.68 on roughly 188 million shares. So this wasn't just a microcap show.
So let's break down why. One of the core themes was, and this is important, company-level execution versus a macro narrative. Managements at Gap and American Eagle explicitly said the economy wasn't the problem, but the market punished them anyway. That tells you the sell-off was more about margins, inventory issues, and forward guidance than a broad consumer recession.
Yeah, the market was basically saying, we don't care if demand is fine today, your margins and inventory metrics look bad, and that matters more for near-term profits. I mean, when you step back and look at this, execution risk can outweigh macro messages pretty quickly.
Absolutely. Another theme was liquidity and turnover as drivers of price dislocations. Friday's largest movers were all heavy volume names. Devs, Intel, Virgin Galactic, SoFi, and ZCMD all had massive turnover. High turnover amplifies moves and can create extremes that aren't always linked to fundamentals.
Right, and that's worth repeating. For microcaps, heavy volume can push prices way beyond what fundamentals justify in the short term. Traders see momentum, they pile in, and a 69% drop or a 140% gain can happen in a day.
We should also call out the divergent investor focus Friday. Income and yield investors were nibbling. Annaly, a mortgage REIT, managed a modest gain of about 1% to $21.85, while momentum traders chased speculative names like SoFi, which gained about 7% to $18.22.
Yeah, so two different playbooks were in play. Income investors were focused on yield, while traders were looking for quick moves and liquidity. That divergence matters for how portfolios reacted.
There was also an analyst nuance Friday. Morgan Stanley trimmed its price target on CMS Energy from $81 to $77, but kept an equal weight rating. That's a subtle calibration, narrowing upside without issuing a downgrade.
That's the sell side doing the math, adjusting assumptions, discount rates, or risk profiles without changing the overall stance. It's cautious, not panicked. Analysts note that sort of move signals refinement more than a wholesale change in conviction.
Let's pause and hit the big data points cleanly. Gap down about 24%. American Eagle down about 13%. Devs up 140% to 30 cents on about 572 million shares. ZCMD down about 69% to 17 cents on about 146 million shares. Virgin Galactic up about 37% on roughly 173 million shares. Intel down about 5% on heavy volume. SoFi up about 7%. Annaly up about 1%. Morgan Stanley trimmed CMS's target to 77 while keeping equal weight.
Nice summary. These are the kinds of numbers that made Friday feel like a volume party and a headache for risk managers.
Totally. Now, disagreements in the market were pretty stark. Management at retailers said it wasn't a macro demand problem, but the market reacted as if guidance and margins mattered more. Then you had the debate on the speculative rallies. Some analysts viewed Devs and Virgin Galactic as momentum-driven with mean reversion risk, while others saw liquidity as an entry point for short-term strategies.
And on the downside, ZCMD's collapse raised the question. Was this a liquidity-driven capitulation or the start of a fundamental unwind? People were split, and those splits create volatility.
Quick reactions. Right.
Yeah, absolutely.
Okay, moving into what this meant for different investor types. Long-term investors were reminded to revisit balance sheets, margins, and inventory turnover on apparel names. Large one-day moves are repricing events, but fundamentals still matter for longer windows.
Income and REIT-focused investors should have noted that Annaly's modest uptick reflected continued interest in yield plays. But mortgage REITs remain sensitive to the interest rate path and spread compression, so book value signals are important, not just price action.
Traders and momentum players saw short-duration setups, Devs, Virgin Galactic, SoFi, but those plays carry big risks, especially heading into a long weekend. Volume confirmed participation, but position sizing and execution matter.
And for portfolio managers and risk officers, the lesson was liquidity risk. Microcap spikes and collapses can blow up mark-to-market numbers and force rebalancing. Concentration in illiquid names is risky into multi-day closures.
Retail investors probably felt confused. Management said demand was fine, yet stocks sold off. The takeaway? Market prices often reflect forward expectations and execution issues, not just current sales.
So, what should people watch going into the next session? First, earnings and guidance versus macro data. The market was treating corporate guidance as decisive, so upcoming reports will clarify if these apparel moves were isolated or broader.
Second, liquidity versus fundamentals. Big volume speculative moves may keep making headlines even if fundamentals don't change. Separating liquidity-driven repricings from real fundamental shifts is key.
Third, watch analyst calibrations versus price behavior. If markets continue to swing wildly, they may diverge from measured sell-side adjustments like the CMS note we talked about.
A couple of strategic considerations. Again, this is informational, not advice. Analysts noted it made sense to reassess exposure to execution-sensitive sectors, monitor liquidity and position sizing, and track forward signals like guidance rather than just headlines.
Also, prepare for event risk around the long weekend. With markets closed, gaps can open when trading resumes. Traders and investors should consider overnight exposures and how a multi-day closure could amplify moves.
Quick check. A few short takeaways before we sign off.
Go!
1. The apparel sell-off looked like execution risk, not just macro weakness.
2. Heavy volume drove extreme moves across microcaps and large caps alike. Liquidity mattered more than usual.
3. Income plays still attracted flows, but mortgage REITs remain sensitive to rates and spreads.
4. Analysts were cautiously recalibrating. Price target tweaks without wholesale rating changes, while markets swung more decisively.
5. And finally, respect the long weekend gap risk. Heavy volume into a market holiday can produce amplified moves when trading resumes.
All right, that's our recap of Friday's close and the key themes heading into the break. If you want the charts or the underlying alpha notes we referenced, those were published May 29th and 30th and are on the site.
Thanks for listening. Quick reminder, this is for informational purposes only and not investment advice. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly through the Q&A feature and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
See you next time. Have a good long weekend and be safe out there.